Okay, so you can just open your Excel sheet, which I just shared yesterday. There's a question. Okay, so I've been doing one practical question, but there will be a theory question, which you have to delve in your paper. Usually based on, this fundamentals, basically. So you can always pick up from here. It won't be practical like what we are doing, but a theory question based on this practical. So have you opened? So I'm recording this lecture so that students who are absent, they can watch it. Okay. So have you all opened this thing? Should we start? Okay, so this is basically a project which is concerning a metro rail PPP project using hybrid annuity. Okay, very similar to HAM. Here there is no ridership risk for the private party. That means this is a metro project where the tickets will be collected by the metro authorities, so they won't get any ridership. Some share of the tickets, but they will get a fixed amount, annuity. So all figures are in crores. A private concessionaire, SPV, is developing a 25-kilometer elevated metro corridor under PPP hybrid annuity model. So construction period is 4 years. Operation period is 20 years. Total concession is for 24 years. So 4-year construction and 20 years will be the operation period. The project will start in the year 5. Start giving revenue to the SPV. So government pays the concessionaire an annuity subject to performance during operations. So the private player will get only subsidy. Okay, annuity. So the fare box revenue is retained by the metro authority. That means the fare box revenue is basically the ticketing and everything will be retained by the authority, and they will not pass it on to the SPV. The SPV is going to get an annuity. Okay, instead of. So the private SPV has no ridership risk, whether people will use the metro or not. So they are not going to be bothered about. So they are going to get some kind of an annuity for doing this project. So the project cost, the given information is that the project cost and funding, the total project cost is 10,000 crores. Government construction support during construction will be 40% of the project. So government is going to chip in with 40% of the amount, paid evenly over the construction years. Balance funded by SPV, which is 60%. So 60%, that means 6,000 crore will be, deployed by the company, the SPV. Debt equity ratio on SPV portion is 70-30. So they have decided that 70% will be debt and 30% will be equity. Okay. Now, question may say that how much should be debt, how much should equity? So most likely 70-30 is considered to be a good one because the company is getting a fixed amount of money from the government. So they can always use leverage to enhance the profitability of this thing. So 70% would be good enough for SPV in form of debt. 30% they can chip in with their own equity. Interest rate on debt will be 9%. Loan period will be 15 years from COD. Repayment would be Sculpted. That means you have to base it on the basis of the revenue. Okay, fine. How much revenue the company is earning. Okay. So, and it will be the minimum debt service coverage ratio is 1.3. So that means you have to make sure that, every year 1.3 is met. Okay. So if you do that, that means it is Sculpted. Okay. So you don't have to put it in a model. So you have to just, make the debt service coverage ratio equal to 1.3. Okay. Debt service coverage ratio formula is basically the total debt. The CFAD divided by the total debt. Okay. Fine. So you use that formula and that should be equal to 1.3. Okay, fine. So we'll do that so to understand. Then, availability annuity paid by the government. So government is going to pay annuity. Base year annuity would be 1,150 crores. So government is going to pay 1,150 crore to the SPV every year. So annual escalation on annuity will be 4%. So every 4 year, they are going to increase the annuity for the SPV. And performance deduction, we are assumed nil. Of course, because he is not able to perform well, then the government can always deduct some money from his annuity. So we have assumed that he is performed and given a full performance and there is no deduction from the annuity. So operation cost is 250 crores and operation and maintenance escalation is 5% per annum. Major maintenance reserve is 120 crores every year. Okay. So, there is 250 crores operation and maintenance and 120 crores they are going to make a reserve. So that means if they are making reserve, there will be no tax, deduction on account of that. Only they will get a tax benefit on 250 crores. So while calculating the tax, we don't take any benefit of tax on that. Okay. Because there's just a reserve, not an expense. So corporate tax rate is 25%. Depreciation ignore for cash flow calculations. Working capital also ignore. Additional revenue. So that means that this company is going to get some additional revenue over and above the yearly annuity. So that will be, station retail plus advertisement revenue, which will be 80 crores. So that means they will be able to, generate some revenue out of the advertisements. They will be provided some outdoors so that they can sell it to someone and they can they can make advertising and give the money to the company. So which is going to be 80 crores per annum, and it is going to increase by 6% per annum. So maximum they can generate is 80 crores and it will keep going up by 6%. Now, this is the question. Okay. Now, first, funding and capital structure. Calculate the government construction support, calculate SPV funded amount, calculate debt and equity for the SPV. Okay, which is all given there, so it's such a simple one. Then year 5, which is the year when they start, getting their amount from the government after the project is complete. So total revenue to SPV will be the annuity plus the non-fair revenue, which is the advertisement. Then the cost will be O&M. So we have to calculate that. EBITDA, cash taxes paid, and CFAD after the maintenance, after the major maintenance. Then question number 3, 15-year, CFADs forecast from the year 5 to 19. Prepare a CFAD forecast. Okay, considering an annuity escalation, O&M escalation, non-fair revenue growth, fixed major maintenance reserve. Debt service, which is given as that using minimum debt service coverage ratio of 1.3, compute maximum allowable annual debt service. Okay. Then the repayment schedule, assuming debt service each year is Sculpted and to DSCR to be equal to 1.3x. So build a 15-year debt schedule. Okay, showing opening debt, interest, debt service, principal, and closing debt. So then, we have to talk about the bankability. Comment whether the project is bankable under the given structure based on debt service coverage compliance, cash flow, stability, conceptual link. Explain 2 or 3 lines why this hybrid annuity availability payment structure reduces financial risk compared to a fare box revenue ridership risk model. So basically, they are not going to participate in the revenue which they are going to generate from the metro. So they are going to get an annuity. Okay. So we have to now whatever theory part is coming. So that's more relevant for us because the question will be a theoretical question. Okay. So then optional ridership is unexpectedly low. What is the direct impact on metro authority, private concessionaire, and the lenders? Here, because the metro authority will be only impacted and not the SPV as well as the lenders, because they are not going to be bothered about that, because this company is going to get annuity plus the advertisement revenue. So they are not participating on the traffic inflow, traffic being used, how much revenue is being generated by through the ridership. So then we go to the answer. So funding. So we know that the total project cost is 10,000 crores. Okay. And government is going to give 4,000 crores, 40%, whereas SPV is going to, put 6,000 crores. And out of 6,000 crores, 70% will be debt. So that means they are going to take a loan of 4,200 crores. Okay, so that is very relevant that this company requires 4,000 crores of loan from the bank. So, so if we start the year 5, which is the year when the project start generating revenue, okay, and the project is complete as far as the construction is concerned, so they are going to start generating 1150 crores of revenue, and then 80 crores of non-fair revenue, which is advertisement. So the total revenue comes to 1230, and then the O&M is 250 crores, so which means the EBITDA will be 980 crores. Okay, fine. So tax will be 25% on 980, it comes to 245. And then we are going to talk about the major maintenance, which is 120, which is not tax deductible, it's a reserve and not an expense. Okay, so that means the CFAD will be 650 crores. So I can just, you can go to the formula and check. Basically, this is the formula: EBITDA minus tax and minus the major maintenance. Okay, so we get the CFAD. So one of the question was that you have to calculate the cash flow, so which is 650. Now we can do, okay, before we do the 15-year period calculations, we know that the annuity escalates at the rate of 4%. So it starts with 4%. That means it will be 1.04 in the second year. Similarly, the non-fair revenue will grow at 6%. So that means it will go to 1.06. Okay. And OM will escalate by 5% every year. And major maintenance will be 120 crores every year. And tax rate is 25%. Okay. Then debt service coverage ratio we have to keep as 1.3. So then we have to make a debt schedule, which is based on 1.3 target of DSCR. So then, we can just start making the full numbers. So the year 1, okay, the loan year 1, which is basically the operational year 5, okay, because 5 years, 4 years it will take for construction, okay. The first year, when the company has to pay the loan, will start from here. The company will start generating revenue. How much? 1150 crores. Non-fair revenue 80 crores. Total revenue 1230 crores. So that is 1150 and 1250. So here what we have done is that I have use the link here. So it is coming from the first this thing. So they're getting this thing. And similarly, the non-fair revenue is also linked here. So which is also coming from the top sheet. Then the total revenue is the sum. O&M is 250, which I have also picked up from my first year calculation. So 250. Okay. Then EBITDA will be basically using the formula. Okay. Then cash taxes, which is 245, which is again multiplied by 25% tax rate. Okay. Then which is EBITDA into 25%, you get this. Major maintenance, we have just plugged in the number. It is given the question that company is going to keep a reserve of 120 crores. Okay. So then the CFAD will be 615. So we have already made a calculation on the top. So which is basically 980 minus 245 minus 120. Okay. Fine. So this is the CFAD. So similarly, you can calculate the CFAD for every year before we move on to the second part to it. So this is going to be, if you calculate the revenue for the second year, it will be multiplied by 1.04. Okay. Similarly, the revenue for the third year will be again multiplied by, if you remove this, and so it will be basically the second year into 1.04. Okay. So like this, we can just project what is the revenue going to be for the entire up to 15 years. Okay, fine. So, so total revenue, O&M, which is again, linked to the formula here, which is also going up by, I think, 4%, 5%. Okay. So this way you can just calculate your CFADs for every year. Simple calculations. Okay. So now we go to the debt schedule, okay, which is given on the side of it. So opening debt is 4,200 crores, which we have taken from here. The company is going to use a debt of 4,000 crores, which is given in the question. Okay. So what we do is basically we take this and calculate the interest first, which is 9% or of the opening balance. Okay, fine. Then the debt service is 473. How we have calculated? We have used this 1.3. Okay, fine. So if you go to the debt service, so we can just, so this is basically based on the formula that total CFADs divided by 1.3 will give you the total debt service. This amount 473 is derived from 1.3 because the debt service coverage has to be 1.3. Okay, fine. Is it okay? So 473 is the debt service, which means the principal will be the balance number, which will be, the interest minus the debt service will be your principal amount. Okay, fine. So closing that will be the balancing figure after reducing the principal, which means this 4,000 crore minus the principal is the debt. So then we just, use the formula for the entire period and we maintain a debt service coverage ratio of 1.3. So we'll find in the 12th year itself, we have reduced to only, amount of 29 crore 79 lakhs at the beginning of the 14th year. Okay. Of course, the loan tenure was 15 years, but in the 14th year, they'll find that they are almost paying all the loan because the cash flows are huge. So we use 29 crores, calculated the interest, and then the balancing figure is debt service. So that means the principal will be 29 crores will be paid and there will be no closing debt. And in the closing year, the debt service ratio goes to 32.18. Right? So it is beyond what the banks want. So every year they are maintaining 1.3. Okay. And the last year, the balance figure will be calculated on only a small amount. So it is 32.18. Okay. So this is what we have to do. Okay. Then key interpretation with debt service, debt fixed at 4,200 crores and sculpting at DSCR of 1.3, the loan is fully repaid in operation year 17. So in the 17th year, they are going to, so this year, they are going to pay all the amount. So which is construction period plus the 13 years of, when they pay off all the loan. So it is fully paid in 17 years. So loan year 13. 13 year mein pay off ho jayega loan. Okay. Including the construction period, it comes to 4 years of construction. That means in the 17th year of the project, the loan will get repaid. So this happens because the availability of annuity and growing non-fare revenue and strong CFADs. It's just because of that we have been able to pay the loan much before that the loan tenor or the loan period which has been given in the question. In real lending, the banks would typically either upsize the debt or backend or smooth debt service ratio. So the loan runs over the closer to the intended tenor. So if the bank wants that they want the money in 15 years, so they can always tinker with that, and instead of 13 years, they will make it to 15 years. Okay, either they increase the debt amount or they they can smooth the debt service. Okay, so then bankability conclusion. CFAD is stable. Availability payments, no ridership risk. So that means banks are happy because there is no risk on the SPV that they'll not be able to pay the loan because they're getting all the money from the government as well as the revenue generated from the advertisement. So DSCR meets 1.3 in all the repayment years. Debt is fully repaid well before the period. So banks are always happy that to finance such kind of a project where there is no risk for the banks, and they always always give a lower interest rates to the companies to finance such kind of a project where there is no risk on their loan getting not repaid. So this is the question. Okay. So I have just recorded.